The MACD divergence is fundamentally different from the MACD crossover, as it emphasizes trend reversals instead of mere crossover points. This distinction is vital for the development of effective trading strategies. Despite the popularity of MACD divergence, it is imperative to validate its effectiveness through rigorous testing. This method safeguards traders against blindly adhering to potentially ineffective strategies. Divergence manifests when the price trend and the MACD indicator move in opposing directions, signifying potential market reversals. Acknowledging this phenomenon enables traders to make judicious decisions. Positive divergence is observed when prices are in decline, while indicators reveal bullish signals. This scenario suggests possible long positions for traders anticipating reversals. Conversely, negative divergence occurs when prices are ascending while indicators indicate bearish signals. Traders should contemplate short positions upon detecting this particular divergence. The effective utilization of divergence necessitates caution, as it often entails trading counter to the prevailing trend. Acknowledging the limitations inherent in divergence can mitigate potential losses. The speaker underscores the significance of clear entry and exit signals in trading. A comprehensive understanding of these signals equips traders to navigate the complexities of volatile markets. Implementing tight stop losses is essential when engaging in reversal trading due to the intrinsic risks involved. This strategy effectively minimizes potential losses when market movements deviate from expectations. The speaker establishes a take-profit target of 20 pips, emphasizing the importance of rapidly securing profits. This approach aims to diminish risk while trading counter to market trends. Trading decisions should primarily be predicated on the signals derived from indicators, which can necessitate a re-evaluation of open positions. Adhering to these signals can profoundly influence profitability. The judicious use of leverage is critical in trading, as it serves to maximize potential gains while concurrently minimizing associated risks. The provided example illustrates the effective deployment of starting capital with well-regulated position sizes. Backtesting strategies yields valuable insights regarding trading effectiveness and can illuminate win rates. The outcomes underscore the necessity of disciplined trading practices to achieve consistent profitability. This strategy permits trading exclusively upon the appearance of entry signals, facilitating a concentrated focus on diverse trading opportunities without restrictive limitations. Such flexibility enhances overall trading performance. The efficacy of this strategy is largely attributed to a favorable risk-reward ratio, which plays a significant role in the overall success of executed trades. Notably, trading against the prevailing trend has demonstrated superior results in comparison to conventional strategies that adhere to trend-following practices, thereby challenging widely held trading beliefs.